Hi there, everybody. Welcome back to our monthly economic insight series from the Office of the Chief Economist at the American Bankers Association. Hope folks are having a good summer. So, for those who are sort of new to the series, a few things. We have sort of done this on Zoom for the past 6 months, and starting this month, we sort of switched to this new platform. So appreciate your support as we sort of transition from one technology platform to the other. By way of introduction, once again, my name is Sai Srinivasan. I'm the chief economist at the ABA, and joining me in the seminar presentation today is JP Rothenberg, who's going to do all the heavy lifting here. A few housekeeping rules. While the look and feel looks different, but in terms of functionality is a similar thing. There is a Q&A box that you see. You can type in your questions at any time. I will be keeping track of those questions, and either I'll answer them on the chat box, or I can raise it for JP or me to address it as part of the presentation. Couple of other questions. We will be after the webinar either tomorrow or later this week. We will be sharing with you all a copy of the deck that we're using today, as well as a recording of this whole presentation. So with that, JP, you want to go to the next slide?
And do.
So just a couple of slides on shameless marketing from the Chief Economist Office. And we did this last month, but we just thought it'd be helpful to do it once more. We generate a lot of content in addition to these webinars, and it's all meant for you bankers. So, this is the sort of the landing page, which has a collection of all the information that we produce, all the content we produce. And if you go on webinars, I think the next slide is it. Yeah, well, sorry, can you just go back to the previous one? Sorry. Yeah, so on the webinars, you will see a few. This is what we have is just a snapshot here. We are sort of formally offering two types of webinars. One is the monthly Economic Insights or State of the Economy webinar series. And then you go on the website, and on the tab, you'll also see links to a parallel series, which is what we call the quarterly State of the Banking Industry. So I encourage people to register for those and join them. So a monthly State of the Economy webinar series, and a quarterly after the FDIC comes up with the QBP. We will be doing a webinar on where we slice and dice the data about performance of the banking industry in the United States. So with that, JP, I will hand it off to you. And I think we've been living in interesting times these past few weeks. So tell us what's happening.
Absolutely. Thank you, Sai. So my name's JP Rothenberg. I am an economist here at ABA with a background in derivatives risk management. And today I will definitely touch on some of the recent market events. They've definitely been dominating the headlines and our attention. And then I'll focus on some of the fundamental aspects of labor, housing, and inflation, and finally finish up with some thoughts on Federal Reserve interest rate policy. So first, because I'm assuming it's on the top of everyone's mind, I'll jump into the markets. And a lot of what we've seen with the recent volatility was driven by the Bank of Japan surprising markets with a policy rate hike. So the BOJ has been known for its ultra loose monetary policy for decades, particularly since the 1990s. And this has taken the form of negative interest rates, long-term yield curve control, and even ETF equity purchases. But in recent years, the Bank of Japan has started making some subtle shifts to tighter monetary policy. such as kind of loosening its yield curve control and stopping its ETF purchases. But even so, the Bank of Japan's been lagging the rest of the world in raising its interest rates, despite having its own kind of relatively high inflation and low unemployment. So this dynamic of kind of lagging behind global interest rates has been putting downward pressure on the yen and upward pressure on higher yielding currencies and assets as traders lever up by borrowing in yen to invest elsewhere, and that's commonly known as the carry trade. Now, what we saw recently was that any real tightening the Bank of Japan will do will cause kind of a reversal of a lot of the capital flows that have been established in its negative and loose monetary policy regime. And so you'll get repatriations, and you'll basically reverse decades of international money flows, which is part of what we saw last week. So last week, the specifics were on Wednesday. The Bank of Japan hiked its policy rate to 25 basis points from, I believe it was 10 basis points and negative 10 basis points prior to that. And that 25 basis points is the highest it's been since 2008. They also signaled that they were going to have their long-term bond purchases. So the Bank of Japan is really signaling the market that it's serious about entering a tighter policy regime than it has been in the past. That caused an incredible amount of turbulence in the Japanese market, which bled into global markets generally. And then this Wednesday, the Bank of Japan deputy governor reassured markets by saying they won't raise rates in the current turbulence. So what we saw was when the Bank of Japan initially raised rates, that's going to be, sorry, that was about right here. We saw a massive drop in the Nikkei, which is their benchmark equity index. And basically within less than a month, the Nikkei went from its recent all-time highs to dropping slightly over 25%, and then rebounding about 10% post the deputy governor's reassurance. So we're still down about 11% on the Nikkei since the hike, even after what was a 10% rally after the governor's comments. And I think what's interesting on this particular aspect is these moves in the Nikkei were higher than even what we saw back in the pandemic. And I believe these moves were on par with some of the extreme market turbulence that Japan experienced during the 80s. We also saw the yen do some pretty significant moves during this. However, even though we see this significant appreciation in the yen, if we look down here at the lower panel, these are the daily percent changes. The move in the yen actually was not particularly outsized relative to history. So the market seemed to be able to absorb the move, and we had a lot of news stories about market participants unwinding the carry trade. But in general, I think that the yen market and traders were able to handle the yen side of this trade. But when we look at a particular carry trade, so this is the borrowing in yen to invest in the Mexican peso. We're looking at this over about a year here, and the blue line is the total return of that carry trade. The gray line is benchmarked against the S&P 500. Basically, what we saw is since the Bank of Japan hiked rates, it took the year returns for that carry strategy down below zero. And this Mexican peso is just one example of the carry trade. It's one of the more popular versions of it. But that carry trade can be done in any kind of cross asset item. So, that's why we also saw issues with the S&P where it was bleeding into the tech sector, as there was likely at least some traders who were borrowing in yen to invest in tech effectively. But when we look down here at the bottom panel again, we see that the moves in the U.S. Markets were not terribly outsized as what we saw in the Nikkei. So at least from that perspective, the Nikkei was definitely bearing the brunt of the market's fear. But what was very interesting to me during that time was what was happening in the Fed funds futures intraday. And so here we're looking at the front month Fed funds contract over the last couple of days. We see the hike right about here. And then on Monday's open, we saw the Treasury futures basically start indicating a 60% chance that the market was anticipating the Fed to do an emergency rate cut within the week, which is pretty phenomenal for an issue in a foreign market to bleed over so fundamentally that traders thought the Fed would do something that's really quite outside its usual practice. So it was very, very concerning there on Monday, but with traders eventually kind of calming down, we just get to see some of these unusual intraday moves as opposed to a wider contagion fear. So the other interesting item I thought during that Monday open was that the 210 Treasury spread actually uninverted over the day. And we've been in one of the longest curve inversions historically that has typically presaged a recession, although we haven't seen one of those come about this yet. But it definitely created a regime shift in the 210 spread to where now we are legitimately flirting with the spread finally uninverting. And I'll touch on later in the presentation why that actually may be somewhat of a concern. So in general, this is looking at volatility. So here the top panel is candlesticks of the VIX. The bottom panel is the vol-of-vol, what is known as the BVIX. And we saw on Monday, it spiked to over 60, the VIX here. And that's pretty phenomenal. We really only saw levels like that during the pandemic and during 2008. So for that to basically open with fears that we were re-experiencing issues of that magnitude was causing a lot of people concern, and definitely lines up with that expectation of an emergency rate cut. Now, since then, the same day, actually, we saw VIX at over 60, but it closed around 30. And that sort of whiplash, I think, was last seen during Volmageddon. I forget the particular year, but it really was not only a dramatic spike in VIX, but also a dramatic retracement. And what appears to have happened now is that markets have calmed down. The effects of the carry trade unwind are not as awful as I think many market participants were fearing. We've seen articles out from the Wall Street Journal and JP Morgan, among others, estimating that the carry trade is either fully unwound or 75% unwound. So there's a remarkable sigh of relief that I think folks thought the unwinding of that carry trade was going to be much more contagious than it so far appears to be. I don't want to say we're completely out of the woods, but at least right now, the markets have basically made back a significant majority of what was lost during that short-led panic. But if we look at this vol down here, we do see that even though VIX is sitting at currently around 25, which is definitely moderately high, especially to where we have been in the last decade, where we've seen VIX down as low as 10. The vol is actually staying kind of notably high. So traders are cautiously optimistic about a lack of kind of further severe market issues. But I think there's a significant amount of wait and see going on.
Hey, JP, just an observation, right? While the media tends to play up the VIX and call it a fear gauge and stuff like that, we also know that volatility has become an asset class which sort of trades, has its own sort of trading dynamics. And so once people start trading on it, the trading activity sort of starts distorting it. And it might sort of lose some of its relevance as sort of an indicator of what's actually happening to volatility. So I presume some of that is playing out here too. So
absolutely, and you raise a good point, because probably some of that spike to over 60 we saw may have been an unwind of the VIX being involved in carry trades, where traders will tend to short VIX to pick up the roll yield as the futures approach expiry. So it is a dirty signal, as it were, because VIX is probably directly involved in a fairly significant amount of carry trade. So yeah, it's what are the better measures we have, but it's absolutely somewhat polluted as traders,
Yeah, I think in plain English, I tell myself, take it with a huge pinch of salt.
So moving on to the labor markets, what I think we were all breathing a sigh of relief this morning at the 8:30 print of initial claims came in right in line with expectations. So there was definitely some significant concern, as we've seen a lot of negative surprises in the employment numbers. So again, kind of a sigh of relief for everyone, as those came in kind of right in line, and actually continuing claims came in almost dead on with expectations, and we didn't see any sort of significant negative revisions either. So that was taken positively by the market, which was currently up, I believe. So that's a good thing. Then when we look though back, we will touch on kind of the negative surprise that we saw, which was that 4.3 unemployment print last month. Which is giving a lot of people some significant concern that as employment continues to deteriorate, we might end up in that negative feedback loop, and the hopes for a soft landing, which seems to be the main scenario people are hoping for and have priced in, at least prior to this week, is potentially not as certain as folks were hoping. And we also see that job postings have continued their slow decline. So this is showing the unemployment rate in blue and job openings per unemployed person in orange. And the dynamic here was shortly after the pandemic, there was just an incredible amount of employer demand, and employees were able to move around freely, and really the power was in the employee's hand. As we've progressed this year, though, we're starting to see job openings really get cut. And not only are they declining in absolute terms, we also see them declining relative to employees. So employers are starting to have more bargaining power in those relationships. And we also see that turnover is continuing to slow. This green line here is from all of these are from the JOLT survey. The green line is hires, the blue line is quits, and the dotted red line is layoffs and discharges. I think what we're seeing here is a general cooling of the unemployment market, not only from the employer hiring side, but also from the willingness of employees to quit and find a new job. Now, what's encouraging, though, is although layoffs and discharges have been a little more volatile than they historically have been, they have not retraced to even their pre-pandemic levels. So employers are still holding on to employees, and employees are becoming less likely to jump ship to try to find employment elsewhere. But this all points to a general slowing of the labor market, although I think some of the increase in unemployment may be driven by kind of this labor force participation rate dynamic, where on absolute terms, that's been fairly steady over the last year or so. But we are seeing more, especially prime age employees for this 25 to 54 cohort, which is this red line. This blue line is the 2024 cohort. And then this green line over here is the 55 plus cohort. Some of the unemployment increases are likely actually due to folks re-entering the labor market, as opposed to employers laying off people or people quitting like we saw in the prior slide. So as far as reasons go for increasing unemployment, this is one of the most benign ones. And I bring this up because I'm sure everyone has heard a lot about this SOM recession indicator that was officially triggered last month and has been in the headlines pretty frequently over the last 2 months or so. And what the SOM rule is if unemployment, the 3-month average of unemployment increases over 0.5% from its trailing year low, that has historically predicted recessions. And so here what we have is the unemployment rate, 3-month moving average in blue, and this red line is that unemployment low over the prior 6 months. And we saw just that last read in July that it broke the 50 basis point threshold that officially triggers it. Although if you look at the individual readings and with the kind of stability of unemployment, it was fairly expected that it would likely, get breached. So this is not kind of new information, but it is interesting that it's officially triggered. However, again, going back to this labor force participation rate dynamic, if that unemployment is being driven more by people entering the workforce, that seems much more benign than folks getting laid off. However, the unemployment rate is slightly concerning when you look at it to past recessions. So what we're looking at here on this chart is the unemployment rate indexed to peak Federal Reserve rates. So when the Fed would start a hiking cycle, once they were done hiking, I indexed all these unemployments to 1, and then saw how it evolved. And so we're looking at the recessions in 2019, in 2006, in 2000, 1995, and 1989. The line becomes dotted when a recession is called and is solid when it's either prior or post-recession. I also cut off the 2020, the pandemic recession, because it would have kind of made the chart scale a little wonky. But what we've seen now is that the current increase in unemployment from its relative lows is starting to outpace the other recessions. So that's somewhat concerning, as this kind of red dotted line is now above some of the prior examples, and could signal that even though the SOM rule isn't necessarily a leading indicator, it is picking up on the fact that we're in a deteriorating employment situation that may accelerate and feed back on itself. So the next section I'm going to hit on is housing. With all the concern around consumers, I think that one of the key questions is how long can this consumer continue to spend, especially with the inflation dynamics and the asset price dynamics that we've been seeing. This chart looks at how home prices have been outpacing wage growth. So housing prices are the blue line. This is the FHFA purchase index, and wages are the red line. And it's very concerning for consumers when your wages are not keeping up with your shelter costs. And this has been a dynamic in the purchase of homes. We can see, since 2012, and obviously that dynamic was also present prior to the 2008 cycle. But this time around, we're also seeing rent starting to outpace wage growth. So similar chart to the last one, where wages are this red line and rent is the blue. And especially, just prior to the pandemic, and now kind of significantly after it, we're seeing rent, consistently grow faster than wages, which is going to put further stress on consumer budgets. And we're seeing some of that in the credit markets, where there's constant conversation as to how long and how much more bandwidth the consumer has to spend. Another indicator of why prices and rents are outpacing wages is that the amount of housing supply has just been unfortunately constrained. So from dynamics post 2008, we have seen that home building, especially starter home building, has not kept pace with the demand. And further, with dynamics around mortgage rates being higher than they have been relatively recently, we're seeing folks wanting to stay in their homes as opposed to even move to a different one. And so this phenomenally tight vacancy rate is definitely an indication that we need more housing supply. And I'm not sure that the pricing dynamics is going to really correct itself until that happens. And I mentioned this, that mortgage rates are really presenting a pretty significant barrier to home buyers. So on this left chart, we have the 30-year fixed mortgage rate average. And we've seen that although it has come down from its peak, pretty close to 8%, now it's just slightly under 7%. We're still much higher than we were during the prior decade, and especially higher than those lucky folks who managed to get sub 3% mortgages, which unfortunately I am not one, but I hope you are. But that's made an interesting dynamic, so that people aren't moving out of houses because they don't want to give up their low mortgage rate. Although we are seeing some clever strategies around assuming mortgages as opposed to selling and refinancing. But if we look over here on the right panel, this is from the New York Fed, we see that interest rate dynamic here, particularly in the refinancing, where during the pandemic, when we had those very low interest rates, we saw a massive spike in refinancing as people were locking them in. But that entire business has basically dried up, even though home purchasing has kept up somewhat a pace, better than it had during the prior decade post 2008. And all of this combines to the common refrain that housing affordability is at a multi-decade low. And this is not only weighing on consumer confidence, it's weighing on their pocketbooks, and is something to really keep an eye on. But the bright side of that is we're likely building up a significant amount of pent-up demand. So if the Fed does start to lower interest rates, we can expect the housing market to probably come alive fairly dramatically. Although with the prior referenced lack of supply, that's going to likely result in more kind of inflationary and asset price increases, as opposed to a truly healthy market dynamic of more houses being built. So then touching on inflation briefly, it's the basic story is that inflationary pressures have come down, but unfortunately for the Fed, they have stabilized above the Fed's 2% target. So here we're looking at a slew of year-over-year price indexes, with the CPI here in blue, the PPI here in green, then core PCE in orange, and regular PC up here. And they all tell a similar story, which is inflation's running somewhere in the high 2s to low 3s, and appears to be somewhat stabilized, but again, over the Fed's 2% target. Now, the Fed has signaled, although not super explicitly, that it may be willing to meet that 2% target as a long-term average. So the requirement for inflation to come to or under 2% is not as stringent as maybe it was in the past. But I don't think the Fed will come out and explicitly say it's going to move its target to 3%, say. So from an inflation angle, I think we're in a place where, as long as it doesn't increase, the Fed might eventually get comfortable that it can meet its inflationary objectives over just a longer time horizon. And when we look at the market's confidence in how the Fed is going to handle inflation, we see that the market never really lost faith. So here, the dark black line is the year-over-year CPI. The blue line is the break-even inflation rate out 5 years. And so this is calculated by using Treasury inflation-protected securities. And then the orange line is the 5 years out. So these are two independent 5-year chunks. And the main takeaway here is that while we saw the 5-year expectations increase during the peak inflation of 2022, longer-term inflation expectations really never budged. And so the market never signaled a severe lack of confidence in the Fed losing control.
So, JP, I think this is what the Fed has in mind when Jay Powell in his press conference makes a statement that we believe inflationary expectations are well anchored. I think this is what they're saying, right? They're looking at these things and saying, well, the market is expecting us to sort of reach the sort of a 2% target over some period of time. So I think that's what gives them confidence. So, yeah. And for anybody who sort of joined this thing late, feel free to throw in questions in the Q&A box. Only we'll get to see it, so don't be shy. Thanks.
Thank you, Saeed. And so the last section here is on the Fed, and prior to last week, I think the Fed was everybody's primary concern. Last week was an interesting dynamic where I was more concerned about a foreign central bank, but I think we're moving back focus to the U.S. And we see here the Fed's policy rate in the top panel, going back to this dotted line in March of 2022, where the Fed started this historically rapid interest rate hike moment. And the second panel, we see CPI. And in the third panel, we see U3 unemployment. And the gist is the markets are starting to, and the economy in general, is starting to look more like a environment that the Fed may be willing to cut. But there's obviously a fair bit of uncertainty as to basically whether or not we'll find ourselves in a near-term recession. But going back to last week's, or kind of the dramatic changes in interest rate expectations, over the last month, the expectations for year-end federal funds rate has dropped about 50 basis points. So that's the market's expecting an additional 25 basis point cuts by the end of the year. This black line here is the federal funds curve in yield terms about a month back. The blue line is as of this morning, and this lower panel is basically the absolute difference between, I shouldn't say the absolute, the nominal difference between the two lines. And we see here is the end of year rate expectations, which again, is showing expectations of a 50 basis point drop in short-term policy rates. Now, I think what was surprising is that most of that repricing actually happened last week with a solid 40 basis points rate cut expectation getting priced in, although that is certainly less than the 60% chance of an emergency rate cut that the markets were fearing on Monday. But if we look through time, we see that the Fed, or that the market's basically always expecting the Fed to cut rates during this entire policy cycle. Here we're looking at, again, Fed funds futures. This red line is the current policy rate. It's actually the front month contract, but it typically tracks very close. And each one of these blue lines is the forward curve as of that date, so where it intersects this red line going out. And the general story that you can take away from this chart is that no matter where the Fed was since it reached peak rates, the market expected those rates to be lower about a year out. And so the concept of higher for longer was taking hold last month. And now with the unwind of the carry trade and some of the concerning employment numbers we've seen, the market seems to be getting increased confidence that it will finally be right on its long-term lowering rates call. However, if we look at a kind of longer-term perspective, this is the same sort of concept where the red line is the current policy rate and the blue lines are the expectations on that date of what that would be in the future. If the market perfectly predicted where the Fed was going, those blue lines would lie directly on the red line, and we see that's rarely the case. And what I want to take away from this chart is that the market consistently underpredicts how fast the Fed will raise rates. And it did that in this cycle, but more relevant to us now is the market also seems to constantly underpredict how quickly the Fed will cut rates. So while the market appears to kind of predict the initial pace of cuts pretty accurately when they actually start, it really rarely predicts the eventual speed and depth of the cuts. And to me, this is a little bit surprising, given that the market has much of the same data as the Fed. And you would think after this long that the market would be fairly good at predicting what the board would be doing. But so far, that hasn't proved itself out. Now, some of the rapidity of the Fed's cuts, though, might be due to them being behind the ball, which is a refrain that we're starting to hear again, that the Fed should have cut its last meeting and is now behind the curve as employment deteriorates, although that's really yet to be seen.
Hey, JP, can I?
Oh, yeah, absolutely.
So, no, this is an interesting thing, right? But if you look at the past two episodes in the past 15 years, they're also like, the macroeconomic backdrop was really stark, right? So the Fed is trying to achieve other financial stability goals and others, which sort of gets them being more aggressive than what the textbook model will require or predict, I guess. So something to think about. There is a question, and it's an awesome question from Perry, which is, I'll just read it. In the past, money supply was a key element in understanding monetary policy, tracking inflationary pressures, and so on and so forth. And we have seen some indications that money supply is falling, but the Fed doesn't seem to sort of ignore any of this. And I translate this as, if you look at all the major central banks, not just the Fed, the Bank of England and others, in their discussion or articulation of monetary policy considerations, they seldom ever talk about money supply. I'll give my views, and then I think, JP, you should give your thoughts. And so there's been a sea change in thinking about monetary policy and articulation of it over the past 15, 20 years, I guess, especially when the Fed started practicing what we call unconventional monetary policy, which is using its balance sheet in a very big way. When that happens, it's sort of hard to talk about money supply. It's sort of relying on a whole range of other tools to achieve its goals. So yeah, it's right. We're all conditioned to think in terms of money supply, but the world of the practitioners, the central bankers, have moved away from talking about money supply. It bugs a lot of people who sort of conditioned to sort of think about it, and they still talk about it, but central bankers have moved on from money supply. So some of us, I no longer pay attention to money supply, but I do care a lot about what's happening to the Fed balance sheet, because it's sort of, to me, a proxy of what's happening in terms of money supply. And this is why we are all in this world of unconventional monetary policy. When I went to grad school decades ago and did monetary theory and monetary policy, monetary economics, there was no discussion of central bank balance sheet. All of that is sort of more recent, and I'm sure they're updating all the textbooks. And we did spend a lot of time thinking about various measures of money supply, but things have changed so much that nobody talks about money supply. It's all the balance sheet. And the Fed has been saying that they're going to be keeping their balance sheet higher for longer, and the justification is more in terms of reserves. And the other thing is, we're conditioned to think about the banking system or monetary policy through the lens of the banking system and all the money sitting in the banking system. Yes, that's where most of the money lands up. But in terms of who's sitting on the risk capital, there is a fair amount of activity that happens outside the formal banking system. So there are some considerations around that also. I don't know, JP, you had any sort of great question, but JP, you had any reactions to it?
So it's a really kind of interesting thing to ponder. My understanding of it, and I don't want to call myself a monetary expert here, though, is that the money supply is this necessary but not sufficient type item for things like inflation. Basically, because we, as you said, Sai, have so many places where this money ends up getting sequestered, especially in our now rich reserve currency model, where the Fed is not implementing monetary policy by controlling the money supply directly, but instead directly setting rates. And so what you end up with is an item where the money supply just gets it just sits there. It doesn't actually enter the economy in a large extent, although it is definitely sitting there as tinder for potential inflation down the line. And so it's almost at least in my opinion, a increasing risk of inflation, but just because it's there doesn't mean inflation will trigger immediately. And I mean, that's basically where I've come down on. And when we see kind of contractions or expansions in the money supply, it's definitely something to keep in mind. But until we become, more reserve constrained, and until that money supply and inflation moves from asset prices to the real economy, it's not as much of a focus for the Fed, because the Fed seems to willfully ignore asset price inflation and really focus on real economy inflation. So I think that's probably the Fed's perspective, and at least my understanding of some of the dynamics there. But I do want to touch on, this prior slide, to pick up where we were leaving off, was if the rate cutting cycle that the market expects emerges, will this again be kind of more rapid than what the market is currently pricing in, even though it's been pricing in and decreasing rates now for the last year or so. But when we look at economic activity, there are some definite concerns. So this particular chart is looking at the Conference Board's leading economic indicators index. I believe it's a 6-month change. In black here, these blue lines are the economic surprise index out of Bloomberg, which basically tracks the aggregate standard deviation of misses of all the economic releases over the last 6 months or so. And we see that when these both of these lines are under zero, that's contraction or concerning. And when they're over zero, it's growth. And then we have the typical recession highlighting here in red. Go ahead.
Yeah, no, there's, sorry to interject, but one of the things just for the audience, when professional economists who do sort of forecasting and stuff like that, they gather around the table, they spend a lot of time talking about the poor quality of the data. And a lot of the economic data that we track tends to be based on surveys. And during the pandemic, as with many other things, survey responses have sort of fallen. So what that means is that that is a bigger question that folks are dealing with, including the Fed, on the quality of the input. There's a lot of data out there, but the quality is sort of questionable. So they have to take a lot of care in terms of how they use it, how they use it in terms of modeling, analysis, and sort of interpreting it. And what that means is there is some of the data can also get revised at a much higher rate than what we have seen historically. So being a professional economist is a hazard these days. So
yes. Yeah, we all love data, but if you can't rely on it, it's definitely disappointing. But we use what we have, and this LEI, it's got the benefit of being a fairly long series. It looks at things like the Treasury inversion. It looks at credit surveys, like Saeed mentioned. It looks at equity market returns, and then a whole bunch of manufacturing surveys and stuff like that as well. And when we look at that absolute level here, we see that we're actually lower on the LEI. Let me switch colors here. Than we were where we entered prior recessions. And when we look at the economic surprise index, we see that the data that has been coming out has been surprising to the downside. So there's definitely a concern, and I think a valid one in the markets and the economy, that all this hope that we had avoided a recession and that we're going to get a soft landing may have been premature. And that's kind of par for the course here, right? Recessions are unexpected, and I think it's simply too early to tell. This chart goes back to about 1985 and shows the year-over-year change in real GDP in the top panel, and against the Fed funds rate in the lower panel in blue. Again, recessions are shaded in red. And I just chose, again, the peak federal funds rates here as kind of the reference line for how long after peak rates does a recession occur. And it's typically around 13 months on average, although we see there's a 15-month lag in 89, an 8-month lag in 2020, 16 months in 2006. And then 13 months in 2019, although that was caused by a pandemic, so probably not as relevant as some of the other ones. But it's still, on average, it takes about 13 months for a recession to hit after peak rates, which is actually right about where we are now. So we're now in the historically average danger zone for a recession. So seeing some of these deteriorations really is concerning, where I think prior it was simply too early to tell. So what...
Can I sort of interject? So just another perspective, and we'll try and include it in the next month's presentation. There is decent research showing that while we continue to, when you use the term recession, people have some pretty bad images in their heads. I don't blame them, but what we have seen, what the data shows from past history is that over time, yeah, we do have slowdown in economic activity, but those things don't last for too long. Any sort of contraction, even if it's sharp, it retraces pretty quickly for various reasons. So either the policy intervention obviously is part of the thing, and the sheer resilience of the U.S. economy is another factor. So that's something which I like to keep in mind when I sort of think about some of these things. So.
Yeah, and I think that's actually it's a recency bias that I have. The recessions that I'm familiar with are the pandemic in 2008. Which there's the Great Recession, right? So it is accurate when we look back at history to have to realize that a recession typically isn't that bad. Although the fact that the recent ones have been so kind of significant, I guess makes me wonder a little bit if there's some sort of fundamental shift that we're now in such an economy that when things go bad, they go real bad, because we have things like the carry trade out there to kind of accelerate the downturn. But
hey, JP, I'm conscious of time. Can we pause if it's okay with you and see if folks have any questions that they'd like to raise? We had one question, which is an excellent one, but because we can keep talking, we have lots of charts. We have another half a dozen. Okay, so JB, why don't you go on and once again, I'd encourage the audience to sort of put in any questions you might have in the Q&A box. You want to wrap us up, JP?
Yep. I'll burn through the next ones pretty quick. Basically, this chart, it's the same as the last one, but it's highlighting just that the only time we reached peak rates and we didn't really see a recession emerge was 1995. And I just want to call attention to the fact that at least the leading indicators were nowhere near as negative as they appear now. So at least from that perspective, I'm not terribly confident that the soft landing Goldilocks scenario is the highest probability outcome. Just looking at the data and how we're in kind of a much rougher place than we were in 1995. The other item I'd like to highlight is how the confidence in the economy, when we look at the equity markets, when we make it inflation adjusted, I think there's a little more concern under the hood. So here we're looking at various equity returns since the Fed started hiking rates back in March 2022. This top green line here is the nominal cap weighted S&P that everybody's familiar with. We see these kind of, this pretty impressive 20% return. But then if we make it real, we see that impressive 20% return actually gets closer to something like 5%. So the 20% inflation that we've experienced in this regime really, I think, has led to kind of a more optimistic view of the economy than real returns would mention. And then this bottom line here is the equal weight S&P real returns. And basically, I do that to take out some of the significant influence of the AI stocks, the Magnificent Seven. The entire tech sector has really been driving equity returns. And we see that's actually negative since the Fed started raising rates. So it's just slightly concerning to see the vaunted equity markets may not be signaling quite as much strength as the headline numbers suggest. And finally, I'll just close on one of the items that really does seem to indicate the Fed may be ready to start cutting rates, and that's the Taylor rule, which is basically a simplified model for where policy rates should be given unemployment and inflation. And this blue line is the Taylor rule model estimate. The white line is the actual federal funds rate, and this bottom panel shows the gap between there. So prior, accepting the pandemic, the Taylor rule is finally lining up where the Fed current policy rates actually are. And if we look at the last decade, the Fed actually likes to have its policy rates below the Taylor rule. So at least from this kind of simplified rule of thumb model, we're in an economy that the Fed may be comfortable cutting rates. So given that, that's all I have for you. Thank you for the presentation again. Please ask any questions of us. We're eager to answer.
Yeah, and we are here for the next couple of minutes. And as we close, once again, the next economic outlook webinar is on September 5th, if I remember right. And then the quarterly State of the Banking Industry webinar is on September 12th. You can find links to all of this on this page, and encourage people to sort of sign up and show up and ask us questions. So thank you. Once again, we are here for the next few minutes if you have any questions. So that is okay. So Tori, thank you, Tori. Glad you enjoyed it. Okay, so we will close with this and see you guys in a month, and hope you all enjoy the rest of the summer break. At least the kids are rest of the summer. So thank you.
Thank you very much.